The global economy is sinking faster than the Titanic. It has been victim of horrible central bank policies. Their aim to fix this terrible scenario has been to pile on way more fiat money and easy monetary policies. Their desire to fix this issue with something that will surely only make this worse is beyond problematic. It's unjustifiable. It's a disaster. You came here for the truth, so let me unveil that for you. Today we are going to talk about what's happening in Europe with the ECB and Mario Draghi. Then I'm going to show you the newest fund manager survey and all the details therein. So much to get to. Also wanted to touch on the fact that the stock market is nearing its all-time highs, and as soon as the Federal Reserve bends over backwards, we are going to watch the stock markets rocket even higher. This is expected, of course, because the market needs this central bank to be weak. Doesn't matter which one, they all want them to be very weak around the world. They want them to be introducing new methods of monetary easing, and at the same time, we see the weakness approaching. The real economic indicators, the hard data that's coming out, is showing weakness. And you could blame Brexit, you could blame the trade issues, but that is only one piece of the puzzle. These businesses today are not running away and hiding. They are trying to do business, but it simply isn't there. There is cause for concern at this moment because when you create stimulus, it doesn't actually provide anything to the economy. You can do public works projects, get people working, that's one thing, but you can't print money in quantitative easing and have that actually benefit the public. It doesn't work. The whole purpose of it is to take their money from the public and give it to the banks, to give it to the technocratic elite. If you haven't figured that one out yet, you are simply not paying attention. Okay, so let's begin with the ECB. Euro falls sharply as ECB's Draghi clears the path for more stimulus. This is new information. We just talked about this not that long ago, how they were introducing a new method of printing more money, call it whatever you want. But of course, here we are just a few months later talking the same game. They stopped their quantitative easing program at the end of 2018, and it was basically like a month later before they started introducing the next one. They had to do so simply because it is an absolute requirement to print a lot of money, more than ever before in history, and you need to do so faster than all of your competitors, because if not, then you will lose out. It is a race to the bottom that we are seeing today. Mario Draghi tried to reassure market players about the bank's ability to act amid growing doubts on the real effect of monetary policy if a new recession were to materialize. After years and years of printing money, nothing actually resolved the issue, nothing made it better, but they're going to try the same thing yet again. They're basically just trying to reassure the market and say, hey, if something happens, we're going to make it better. We're going to do so by reducing interest rates. Oh, wait, it's already negative. And we're going to print some more money. Oh, wait a minute, we already have 5 trillion worth. It doesn't ever stop. The whole purpose of it is not to benefit you. It is never to benefit you. It will not benefit you. It only takes away from you. People are not realizing this, unfortunately, and they are getting hurt by it directly or indirectly. This is the actual speech that Draghi said. I always want to give you it directly from the source, not just reading it from the articles because they twist it, they take it out of context. I brought you this and it is specifically just to show you the sources, and as well as I wanted to mention the fact that this is from the Biz website. So I scanned through here, I found a little bit of humor that I wanted to bring to you. Quote, there is mounting evidence that these instruments have been effective. Yes, that's right. He actually said that they're reducing interest rates, that their printing money has been effective. I don't know exactly how effective it has been for the average person, but certainly it hasn't even worked in order to bring about what they say is the goal of it. So I don't know what he's talking about here, but it's pretty funny that he actually even went so far as to say negative rates have proven to be a very important tool in the euro area, and more so than they would have been in an economy like the United States. So they go on and just basically telling everybody how everything is going to be okay. Don't worry, we got it taken care of, but it's just one failure after another. I just wanted to show you that directly from the source itself. Global dollar volume of negative yielding bonds, you can see for yourself that there is nearly $12 trillion worth of negative yielding bonds. This continues to grow, and it is absolutely detrimental to the future of this financial system when you have all of these financial assets that are so risky to begin with, especially now, especially what we have seen since the euro sovereign debt crisis, and yet all of this continues to mount. We've got ourselves a problem. Take a look at this, the negative bond yield matrix. Look around the world and see negative, negative, negative. All in Switzerland, all throughout, we have negative yielding interest rates. The 30-year, the 6-month, it's all negative. Germany is pretty much negative all throughout. Netherlands, Japan, Denmark, so on. Most of these countries, any of their bonds you buy, they are giving you negative interest rates. That's right. You put your money in, they give you less back. How crazy is that you would put in something for 10 years, for 30 years, and you get less than what you put in? Forget about all of the inflation along the way. We are talking about actual negative returns. This is completely messed up. This is when you know things today are screwed up, when you can't even get a return for taking such a risk. The next time we have defaults, they won't be from corporations, they will be from countries. They're all insolvent, and suddenly we're going to wake up to that truth. This is the introduction to the Bank of America Fund Manager Survey. Investors haven't been this pessimistic since the global financial crisis of 2008. Wait a second, it's not just the money GPS? No, look at what's happening. Equity allocation saw the second biggest drop on record. Cash holdings jumped the most since 2011's debt ceiling crisis. Concerns about the trade issues, recession, monetary policy issues, all contributed to a bearish sentiment. I'm going to show you all of the different charts that are associated with this momentarily, but just know that the Fund Manager Survey allocation is implying recessionary conditions. Net percentage say that they are overweight bonds. You can see the asset allocation, global bonds. It might be hard to see on the screen here, but basically we're looking at this red circle, and it is pointing to the amount that is currently held out there. This shows us the severe weakness that is there in the economy, in the financial markets, but it doesn't get pulled up when you look at your S&P 500. If I look at the Netflix stock, if I look at the Amazon stock, I'm not going to get any of that. I have to look deeper. So that's just one part of it. Looking at the record drop in the Fund Manager Survey, global growth expectations, month over month change. This is down at least back 94. We can't see any further than that on this chart, but it's the worst it's been month over month change since at least 1994. So we see weakness that is definitely present for all of these fund managers. And I forget the total quantity, but we're talking about hundreds and hundreds of $billions that are being managed by these fund managers here. Record number of fund managers say that the global economy is in a late cycle. The green line, that's the late cycle. So I've been showing you this as well. And now we have approached what seems to be approximately 90%. That's an estimation based on what I can see here. This is now assuredly where we are at. We are in the late cycle, okay? So that has been approaching all throughout 2018, getting close to that number. It doesn't really matter ultimately because they are able to push this off for long periods of time. I wanted to note the fact that this was actually not the case back in 2008 because everyone was sidelined. You can see it was at 70%, maybe 75% at its absolute peak. And look how their minds change considerably. So you saw early cycle that was basically nobody back in just around the beginning of 2009. Then it starts to spike up dramatically because, everything's going to be fixed all the while here when they started money printing. And then it dropped down severely because we had a serious crisis that was not being resolved by quantitative easing in the previous cycle. We saw that already. We knew the effects of it and it was being felt in 2018. 2010, in 2011. Into 2012, you had the sovereign debt crisis that started to expand further. And then what they said was that they were willing to risk these currencies permanently. They were willing to ruin them, to destroy them, and that's really what we have today. All countries around the world have permanently ruined the financial system. There is no way to turn it around at this point. You cannot print, let's say, $20 trillion worth plus all of the hidden money, the 16 trillion of the Federal Reserve and beyond. Actually, they technically printed more than 16 trillion. But anyway, all of that money that was disclosed at a later date. But if we just go with the balance sheets globally right now, let's just say $20 trillion of all these central banks, you can't restore that. You can't start to unwind it. It is impossible. All of that is helping to push interest rates down. Okay, so how do you get interest rates down to go down further? You have to print even more money. Open market operations. If you don't understand it, you gotta learn it. US dollar valuation, the highest since 2002. Net percentage say that the USD is overvalued. And you can see going back to 2002, just showing you here where all the money is going, okay? It is not going where it once was. I will show you more on that in just a second. Month-on-month changes to the Global Fund Manager Survey positioning all defensive plays. At the top, staples, then utilities, then bonds, then cash. And you can see the cyclical plays go in here with tech in the negative, Eurozone banks, equities. All of these are looking like money is leaving them, and the money is definitely going into what they would refer to as defensive plays. This is something that I show you every single month, the evolution of the fund manager survey's biggest tail risk. Right now, the trade issues continue to be on the top of the list. Basically, for the last year at this point, the trade issues are number one. We keep seeing these hopes everything's going to be resolved. We have our guys looking into it, but ultimately it never does. It never does get resolved. We were 95% done. Everything was totally ready. It was going to be a 90-day thing. Then it was going to be done by the end of the week. We're ready to sign the papers. It's a done deal. Then it was completely off. We're going home. Everything's done. We're not going to resolve this. And they started heating up again. We don't know until it's signed. And even when it's signed, which I'm sure at some point there could be resolution to the trade deal. China wants to buy some of that agriculture. They've made that known. Right now, they're not doing so. The actual imports from China have slowed down from what I had seen, but they own over $1 trillion worth of treasuries. They do want to be partners. I assure you, I think it is beneficial for China to be a partner with the US as well as the US to be a partner with China. They can do business together. There's nothing wrong with this as long as both sides are agreeing on a good policy, of course. But this right here is not about a trade deal and about agriculture. That's like a small piece of it. This is about hegemony. This is about a power struggle. What do you consider the biggest tail risk? The trade issues have moved up considerably. The darker blue color is June and the lighter blue is May 19. So you could see how much that has really grown in the last month when everything started falling apart. And of course, they were at odds between each other. This is the most crowded trade. Right now, there's a big flip because long US treasuries happen to be the number one trade. The last time we saw anything like this, long US dollar back in the December, January timeframe, we had some long US dollar, but ultimately it was long tech stocks. That was huge for the longest period of time. So we're going to see if that really continues to be a pattern next month. I will definitely show you that, give you an update. As you can see here, what do you think is the most crowded trade? June to May, big difference for long US treasuries. Long US tech has been scaled back. So that's all. I'm going to end the video there. I just wanted to update you on everything that's going on. If you appreciated that, just hit that like button. That's all you got to do. You support me by hitting the like button. When you hit the like button, when others do as well, which by the way, only about 10% or less people actually click one button after watching all the information that I packaged together. You just got to do that. You support me. It helps to push these videos higher up into the search rankings. I do appreciate that. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to know what's going on in the financial system right now, I got a video for you. Click on it and I will see you there.